Today, I want to give you guys a full update of day 6 of the Iran war situation and how it impacts the markets and our precious Bitcoin. There is a pretty high potential to be a significant fallout on the price of oil as it kept spiking day after day, and I have been tracking this, and it really does look like we could be hitting somewhere around $100 per barrel of Brent crude, which is very bad. So I want to give you guys the full summary of why this is bad, what the timeline is, how you can monitor this, what the other main Wall Street analyst firms are saying, and more importantly, why this could be an opportunity. So the quick summary here, in one sentence, we are on day 6 of the Iran war. Both sides are not slowing down. The US just sank an Iranian warship with a torpedo for the first time since World War II. So this marks what some people are calling the biggest US conflict since Iraq. And Iran, on the other hand, is launching drones all over the place at Qatar, UAE, and now extended to Azerbaijan. So the Strait of Hormuz is effectively shut off, and this has led to oil prices going higher and higher. While Bitcoin and gold and the S&P is holding okay, there is high risk. So that's what we want to discuss today. And I just want to make this perfectly clear, starting from the beginning. Even though there is a short-term potential for Iran war to have a fallout to impact all markets, it doesn't mean I'm bearish on Bitcoin. Just putting this out there, okay? Even if we have a short-term crash, I'm not going to be selling my Bitcoin. I will just be monitoring the situation and trying to buy in the short-term crash, because ultimately, if history repeats, markets recover very quickly. It's just a matter of is this thing going to be over with in a very smooth fashion, or do we have some sort of a crash before a Fed intervention? So let's get into it. Here are the main narratives I wanted to cover for today. So first, we will cover the current Iran war conflict situation. So here are some of the main updates. The US carried out a submarine torpedo strike yesterday that sank an Iranian warship off the southern coast of Sri Lanka. And you guys have probably heard of this name recently, Pete Hegseth. He is the in charge of the Department of War, if I'm not mistaken. So Hegseth says U.S. submarine sank Iranian warship in international waters. Big escalation. Defense Secretary he is. And this marks the first time of such an attack since World War II. And some good places to track accurate updates of the conflict is something like understandingwar.org. They put out special reports on a nightly basis. And every day, I like to follow this timeline because I consume a lot of it from the US side on X. So I just want to get some different perspectives. And as we speak, the US side has said that they want to back Kurdish offensive in Iran as a invasion on the ground. So this is another escalation that could happen. So that's all I'm going to say about it. Basically, it's continuing to escalate, and that's that. And what will this lead to for the markets that impacts what we care about? Well, the Strait of Hormuz is blocked. It has been blocked for 6 days now. there's no question there. And very quick summary, the Strait of Hormuz is responsible for 20% of the global oil shipments, mainly going out to Asia, but the rest of the world as well. And obviously, when there is lower supply with the same demand, prices increase. And especially when a global asset like oil does this, prices increase very quickly. So you see Brent crude oil futures are just going higher and higher day after day. And we were watching this, 75 range right before, right on the first day of the conflict on that weekend, and then looking at 78 as a potential resistance, but there has not been any resistance. It's pretty scary. And I'll get into exactly why and all the price levels to watch in a bit. So the other fundamental thing you need to know of why the Strait of Hormuz is important to be opened right away is this. So not only is it a supply issue where 20% of the supply is cut off, but also it's a storage issue. So there is a race to open the Strait of Hormuz so that all of the oil tankers can actually leave the Persian Gulf. I'm pretty sure that's the correct word. And if they do not leave, what happens is the production of oil from the Persian Gulf countries will be shut off because they don't have, as they produce more and more, they need the storage facilities, and the storage facilities will fill up. And here, not this one. Which one? Here. Hormuz scenario is that currently there are trapped oil and gas in the Gulf. This Gulf. So these countries that produce oil, they cannot ship it out, and their storage facilities will be will fill up very quickly. Exactly how long? There is a here. So JP Morgan analysts have done the math and warned that the Strait of Hormuz need to open within 25 days. Otherwise, oil production will need to be stopped. And this is worse because essentially they will run out of storage and they cannot produce any more oil. So there is a pretty tough cutoff here. JP Morgan predicts that in a scenario where the strait is completely blocked, Middle Eastern oil producers can only maintain normal oil production for a maximum of 25 days. Once the blockage exceeds 25 days, crude storage will reach saturation, forcing producers to cut output or even halt production entirely. Pretty bad. So, from this week's live stream, we covered how Trump has said that they expect this conflict to last between 4 to 5 weeks. So that's roughly the same period. 4 weeks is 24 days, 5 weeks is 35 days. So that's roughly the timeline. 4 weeks, we are currently in just under 1 week. Let's see how long it can last. Okay, so far hasn't broke yet, but we don't want it to last that long. Okay, here are some projections that analysts have made. So first of all, who will shut oil first? So Iraq, well, the different countries in the Gulf, they have different storage facilities. And Iraq has already shut off. This article is blocked, but yeah, I'll just take their word for it. Iraq has already shut. Kuwait is next to watch, and then Saudi says they can keep storing their oil production for 2 weeks before they have to shut off. And the US has to reopen the Strait of Hormuz as soon as possible. This is based on Bloomberg. And the halt from the Strait of Hormuz may exhaust oil and fuel storage in weeks or days. Here's how many days people each of the countries have. Iraq first, Kuwait, UAE without routing, UAE with rerouting, Qatar, Saudi. There you go. So roughly by 25-day mark, most of the countries will be shut off. Okay, then let's look at the effect of this. So there's a very in-depth piece here of the math behind it that Goldman Sachs put out. You can read this. It's actually not that long. Basically, how they came to these numbers, but I'm not going to go too deep on this. I'm just going to give you the numbers from different firms, which mostly they all agree. So that's this piece. You can find this on Bloomberg, but Bloomberg is paid. So Yahoo Finance has the exact same, just not paid. So Citigroup says, here, I'm going to give you the full projection based on the price of Brent crude, how high it can hit, and the effect of it. Key price levels to watch. Currently, we are at that 85-ish mark. This is manageable, but this is uncomfortable. And this will add about 0.3% to global inflation over the next 6 to 12 months. So we already will feel this. It won't be that bad, but we will feel this. Because oil drives what? Drives gas prices, and it drives inflation in the quickest way. Now, let's go back to this. Citigroup expects the global benchmark to trade between $80 to $90 this week, which is already where it's at. And it's probably not going to go down from here. Goldman Sachs. Goldman Sachs said that if we have a full 6-week halt of the Strait of Hormuz, prices are expected to rise another $18, which is over $100 per barrel. And their piece came out 2 days ago, March 3rd. So from March 3rd, from their calculation of prices was around $80. So they are expecting just under 100 with a 6-week blockage. And disruption in the strait could also be very significant for gasoline, for jet fuel, and because about 9% of the world's daily gasoline supply and around 18% are transited through Hormuz. Okay, and here is what Wood Mackenzie says from, what Wood Mackenzie says. Oil prices could exceed $100 a barrel if tanker flows in the strait aren't quickly restored. Basically, that's 6 weeks. JP Morgan Chase says, let's see if they say anything about the specific prices. Yeah, so storage facilities will fill up in the region. They will, and production will need to be shut off. Morgan Stanley says, $80 per barrel at least for the second quarter. I mean, we are already there. That's kind of silly. Okay. RBC Capital Markets says oil risks hitting $100 a barrel if there is sustained navigational disruption or attacks on any critical energy facilities in the region. If the conflict drags on, the consequences could quickly become material. Regional producers like Iraq may have to shut in output if it cannot move its roughly 3.5 million barrels a day of southern exports. We already see that they have been doing this. Iraq is on the 6th day. Iraq has to shut off their production very soon. And okay, and then we go to Citigroup. Citigroup is interesting because they are the only firm who said not only, okay, we're currently between 80 to 90, we are likely to hit 100 if the war goes to full length, 5 weeks, but it could head even higher. So here's what Citigroup said. Our baseline view is that the Iranian leadership changes or that the regime changes sufficiently as to stop the war within 1 to 2 weeks. Very optimistic. Or the US decides to de-escalate, having seen a change in leadership and set back Iran's missiles and nuclear program over the same time frame. However, if regional oil infrastructure gets hit, prices could rise as high as $120 a barrel, assigning a 20% chance to this scenario. So basically, $100 is what most Wall Street firms are projecting, which is bad because most of these firms see that this war will probably drag on. Even Trump himself says, okay, 4 to 5 weeks, and 4 to 5 weeks is already enough to cause all the disruption in the shipments. And in a very low probability scenario, 20% chance, if the actual oil infrastructure gets hit, then oil prices could go to $120 per barrel. Now, what will be the effects of this? At 80 to 90 range, it's manageable, like we said, because as you see in the markets, okay, things are okay. S&P, it's dropping a little bit, but it's fine. It's not too bad. Gold doing its thing, Bitcoin doing its thing. Not too much disruption, manageable. The inflation numbers will be bad, but maybe it won't appear right away. At $90 plus, which is somewhere up here, okay, let's say 95, these resistances get hit. We could see some real pressure on the economy. So the flow is like this. When oil prices increase, it leads immediately to inflation in the fastest way. And as inflation rises, the Fed needs to delay rate cuts. So we see that the next Fed meeting is on March 17th to 18th. This is actually all playing out together in the next 2 weeks. The people are already fully pricing in there will be no rate cuts. And it's already bad enough. Well, inflation numbers are slowly rising. The Fed inflation number that they like to watch is core PCE, and core PCE is currently at 2.99, just under 3%. The next time that the core PCE will be released is on March 13th, which is 1 week from now. So you can imagine what this is going to do. Oil prices stay high, inflation stays high, core PCE number gets bad, CPI number comes out on the 11th, it's bad. Even though these numbers will cover January, it will already start to price in for the next numbers. Okay, you have to think about it like this. The numbers are forward-looking. So even though people already know that the Fed probably won't cut rates for this March 18th meeting and then probably the April FOMC meeting, they have projected like some sort of a cut in Q2, Q3. When you look at these July probabilities, by July 29th, okay, by June 17th, right after Kevin Warsh comes in as the new Fed chair, there's about a 29% chance that there's a cut, and 67% chance no cut. While poly market, so where people are betting with their money, is for 28%. So most people agree around the same range. One cut in June. Now this will get heavily impacted by not this inflation number, but the next one and the one following. So you could imagine this. The January inflation numbers will be fair because it's not going to take into account the Iran crisis. But then the February and the March, it's going to look bad. And that will directly impact here, looking at the meeting timeline. Not the March, not the April, but the June. It's going to look very bad. So when Kevin Warsh comes in, we already know he's a hawk from history. And Trump obviously wants him to cut rates. But he's going to have a hard time because there's a dual mandate of the Fed. They have to keep inflation low and employment high. Employment is not doing too hot. Unemployment rate is rising, which is one reason for them to cut rates and potentially do more QE. But if inflation is high, then they're trapped. So this is why the effect of the Iranian war and oil crisis will not impact the March FOMC meeting immediately, and probably not the April one, because that one will still be heavily driven by Jerome Powell, and it's the last meeting that he will announce with a plan. So likely he's not going to make a sudden change right before he leaves in April. But then the first one after Kevin Warsh comes in is going to heavily depend on how bad oil prices get and leads to higher inflation, which leads to the Fed having a harder time to justify rate cuts. So that's why this is all going to trickle down. And because the markets are forward-looking as well, what the actual Fed decisions in June does not matter as much, because everyone looks at these Fed watch probabilities, whether you look at this CME group one or you just look at Polymarket, Kalshi, whatever. These probabilities are what people actually look at. So there's the Fed decision, and there is QE, whether Kevin Warsh will do heavier QE or not. Those prediction markets and those probabilities will heavily be influenced by this month's Iran crisis and how long it lasts. If it lasts very long, it's highly likely for these numbers to decrease, which will add to sell pressure in the market, because that's what the market cares about. It's the narrative, it's the news, it's the forward-looking possibility of the news, not the actual day of the news. So that's why this all matters. Okay? And if we get, $90 plus of oil price above these highs, that's already going to look quite bad. And most Wall Street analysts and their firms agree that we probably will get these range because they're already looking at 100. So just be careful. Let's say one more week passes and the war doesn't de-escalate and the Strait of Hormuz is still closed, probably we are already above 90 in oil prices. And it's going to look pretty bad in the short term. And then if we get above 100, you can basically follow all of the Wall Street firms' analysis of the effects of this. And then 100 is what they expect in a 4-week period. So from now, which is right about the end of the first week of the conflict, going into another 4 weeks, we are looking at 28 days, beginning of April. Okay, this is a big uncertainty period you gotta watch out for. So yeah, watch out for it. Most important thing. And let me see my notes here. What's the next logical step here? Okay, what does this mean for the trajectory of the markets and the trajectory of crypto? So if you're holding gold, there's not much to say. I mean, gold is probably the safest bet right now for something to hold. Even if oil prices are bad and it keeps going up, gold does not have that high correlation to a short-term crash. However, even if you're holding the S&P or stocks or equities, you got to be careful because as history shows, in past conflicts that involve oil, if you look at the article I put out, markets could see a big dip right around this period because of the short-term disruptions. While it is true that 3 months after the conflict, the S&P trades higher every time, there could be a short-term crash. So you got to be prepared for that. Very simple. Yeah, just be prepared for that. And on the Bitcoin side and on the side of crypto, what drives crypto and what specifically drives Bitcoin? It's market sentiment. Market sentiment is most obviously correlated with the S&P. So that's the number one thing. Number two is liquidity. Market sentiment is also driven by rate cuts, the expectation of rate cuts. So if oil prices spike, inflation goes higher, and the probability of rate cuts decrease for the Q2 cut to not come, then market expectation for risk-on assets will decrease, and that will add to some sell pressure on Bitcoin. But then the actual buy and sell pressure is most heavily correlated with QE, with liquidity. And well, if the Fed cannot find a reason to cut rates, it'll be even harder for them to justify using QE, at least in the short term. But fear not, it's not going to last forever. Okay, so you got to think about it like this. Who even initiated this war? It's Trump. What is Trump's goal? He wants to hold as many of his of the Republicans' seats as possible in the midterm election year. So the midterm election year is from now until first week of November. And what does Trump like to do the most? He is a markets guy. He is a investor, a finance guy. He loves to play with Wall Street. So even if there is a short-term crisis, Trump's goal will never be to crash the markets. And even if it crashes in the short term, he just wants to act as the savior. This is why he keeps trying to bring back, tariff dividends as a new form of stimulus and trying to let the Fed cut rates, etc. So this seems like the most desperate thing he's done so far to give himself kind of the excuse and give the Fed the excuse to step in a big capacity. So for the first time in a long time, I actually agree with Arthur Hayes. When Arthur Hayes has always been way too bullish on the Fed policy, and he keeps calling for the Fed to cut rates very, very aggressively over the last 2 years. But his latest piece on this is pretty logical. So I recommend you guys to read this. But I'll just break it down of exactly what he said here. So he says, the longer the US stays bogged down in the expensive Middle East war with Iran, the higher odds that the Fed can finally cut rates very aggressively and or do QE very aggressively. However, it doesn't happen in the short term. The only way this can happen is if the conflict just goes to full length and goes to 4 or 5 weeks. Oil spikes above 100. You have all of the things happen like we explained. Inflation is very high. And the Fed gets trapped. So the Fed in the short term cannot act. Kevin Warsh comes in with his dick in his hands and says, hey, I'm new here. What's going on? And, oh, I can't cut rates. Oh my God, what's happening? And then things actually get really bad. And then they have all the excuse in the world to say, let's cut rates very aggressively. Let's do QE very aggressively. So Arthur Hayes gave some solid examples here, looking at the repeated patterns since, not this one actually, this is the budget. Here, looking at the Gulf War, the short-term effect versus the few months after. So from the August FOMC, the Fed, let's get this exact timeline. Okay, when did the 1990 Gulf War start? It started in August 2nd. And then in the August 21st FOMC meeting, 3 weeks after, which corresponds to the FOMC meeting this week, they didn't do anything. But then by the November to December FOMC meeting, which is how many months? 4 and 5 months later. No, 3 and 4 months later, the committee cut rates. Okay, and here is 2001, right after 9/11. I mean, that one is very sudden. We know exactly what happened there. 2009, Iran. Did he mention Iraq here? Let's see. The timeline. I wish he had mentioned Iraq here. Nope. But he did mention it on the interview. Anyways, okay. Claude, go do this research right now. Anyways, no. The point is, if there is a short-term crash, it will be because the Fed cannot cut rates or use QE in the short term. So if the conflict goes the full way, 4 to 5 weeks, we will not be able to see the Fed step in immediately. So that is something like the next 3 FOMC meetings, we're not going to see much. Because the first 2 is going to depend on the January and February numbers for inflation and for unemployment, which is not going to reflect at all. And then by the June time, Kevin Warsh comes in, it's his first meeting. And we know usually the first meeting at the FOMC, he doesn't do much. The new Fed chair doesn't do much. The real one that we need to watch is in August, like we have covered before. In the August Jackson Hole meeting, he will need to give his long-term statement that he wants to carry out for the first year of his term as the Fed chair, and he can really make a big statement there. So that will correspond very nicely with what can be the big pivot, the big, statement. If he says we're going to cut rates more aggressively, or we're going to print money more aggressively and do heavier QE. So because from now until June, we're not going to have much support from the Fed. That's 3 whole months. And in that period, oil prices will not care. I mean, oil prices, if it goes to 100, it will go to 100. And actual inflation will not care because we experience inflation on a month-to-month basis. But the inflation numbers get released like 1 to 2 months later. And then the Fed acts 1 month after that. So be ready. The summary here is be ready. There is basically at least a 3 months gap from what the market will act to the time that the Fed can actually act. So be ready. If there is a crash, it really could be this period. And the good news is, if there is a crash, it will make the most sense to the Trump camp, because for the longest time, they have wanted heavier rate cuts, heavier liquidity support, whether that's from QE or from TGA to do stimulus. And it really looks like Trump prefers it to be stimulus because it sounds the best. It wins him the most votes. It wins the party the most votes. So the two things we need in order for Bitcoin to do well, rate cuts, which influences market sentiment, and liquidity coming from probably the TGA first, from Trump stimulus, which actually adds to the buy pressure. These two things are both blocked right now. The Fed cannot cut rates because they're kind of trapped. They don't have big enough of a crisis, of an excuse, nor is the inflation and unemployment good enough in a condition for them to cut. And on the stimulus side, well, Trump is getting blocked left and right by Congress. So this really looks like emergency measure. And if it's really emergency measure, we're going to see full-scale escalation. And if we do see full-scale escalation in the next month, then 3 months after that, maybe we will get heavier rate cuts and heavier stimulus liquidity. So be prepared. What I'm trying to say here is Q3, Q4, markets could get the final, the big thing that we need for Bitcoin to pump a lot. But in order to get there, we need to have a short-term crash. That looks like the playbook that Trump is carrying out. So just be prepared for that. Again, it might not even happen. Maybe the thing just stops, okay? Maybe both sides calm down and oil prices do not spike and we are all fine. Then that's totally fine. But just, if it's not fine, be prepared. So what am I acting on right now? How would I, treat my portfolio in this scenario? DCA Bitcoin. So like I said yesterday, when someone asked me in the Q&As, hey, Bitcoin is pumping to 73K. It was yesterday. Should I buy now? Is it going to go up in a straight line and reverse into a bull market? I told them no. The chance of that happening is extremely low. There is so much overhanging uncertainty that we are likely at least going to chop below 70K. And if oil prices do not come down, we are going to have at least a longer chop, okay, for the next month. And then if it lasts longer than that, then prices could even head lower. And that totally matches 2022 bear market, where the 200-week SMA gets touched at 58K, and then we could even trade below that and just kind of chop in that range, form a bottom until the midterm election year is fully over. And if you think about it deeply, this all makes sense. Okay, this all makes sense together. Why does it have to take from now until the midterm elections are fully over is because it's all engineered. It's all to get to the final goal, which is just a power move. Trump is a markets guy. He needs the markets to do well for himself to look good, but he's trying all he can. He's trying to just spend the TGA account, but he's getting blocked. He's trying to let the Fed cut rates, but Jerome Powell doesn't want to do it. So then what does he do? He picks Kevin Warsh, who is a hawk. And if you studied Kevin Warsh, just with AI, Kevin Warsh is his main shtick is that he doesn't want to cut rates too aggressive or use QE unless something breaks. That's his whole thing. He says, hey, the Fed should not act until the thing fully breaks and then act very strongly. If you just ask AI, what the main, what's it called? What the main narrative that Kevin Warsh takes, this is literally what he says. This is his stance, his economic stance, what he believes the role of the Fed should be. It's to not act until there's big emergency and then act very aggressively. So if you think about it, this makes sense why he was picked. He can carry that out exactly. If there is a big crisis because it's engineered by Trump, he can do this. He's going to bring out his economics book and say, hey, here's what I said, and now I'm the Fed chair. We have a big crisis. Let's cut rates very aggressively. Let's print money, a lot of it. But that can only come if there's a big crisis. So just watch out for that. Okay, and that's basically it. That's a scenario that I totally could see happen now because, it's two things. We have a new Fed chair, and the Fed chair believes this, and he was picked. And then Trump, he's doing all he can to have rates lower, to use stimulus, but he can't do it in a normal way. So he goes and initiates this craziness. And we also have the timeline. Okay, so in the last 3 years or so, we have always said, hey, Trump is trying to engineer something. And he's trying to crash the market so that he can let the Fed do its thing. But two things always were there. Jerome Powell doesn't see eye to eye with Trump. So even if Trump does something, Jerome Powell can still do something else. Jerome Powell can still do something else to protect his legacy. But now we finally have a new Fed chair. And the timeline is very short now because over the last 2 years, Trump was already in power. But this year, it's the midterm election year. And we know this time period over the next 3 months or so. We even know to the weeks, okay? Each day that goes on, oil prices will head higher, which raises the probability of a crisis at a bigger scale. So it finally makes sense to speculate on this scenario of a engineered crisis leading to a heavier rate cut, a few months later, and heavier QE in a few months later. And that's why, finally, I think you should consider this, and you should read into, what Arthur Hayes said here. Even though he has always been saying this, he has always said, oh, Trump is trying to crash the market. And then, tell the Fed to do his bidding, and then he can come back and be very popular. It never really made sense because we didn't have a time frame, and we didn't have the thing to track. Is there going to be a crisis or not? What is the crisis? Well, now we know it's the Iran crisis. It's the biggest one since Iraq. And we have the time frame, and we know that there is a guy to replace Jerome Powell to do his bidding, and the timelines all match up. So that's why I think this actually could happen this time. Look into this. If you don't want to read, then you can watch his latest interview on Milk Road, this basically lays it out very simple. I think this could really play out. So be prepared if there is a crash in the next 3 months, because if the crash is very big, then chances are after Kevin Warsh comes in, that's going to be the big recovery that Trump has been waiting for a long time. And he finally has all the pieces in place to do that. That's it for this video. Subscribe to the channel if you think these are helpful and you want to keep getting these daily live streams. Make sure you subscribe to the channel so you don't miss another one. And check out my page on X, where I will be dropping day-to-day alpha before these in-depth videos, thanks to the power of AI. Okay. Thank you guys for watching, and I will see you on the next video and the next live stream. Bye-bye.